Hey guys, I hope everyone's doing well. Today I'm just going to briefly discuss some of the effects of COVID-19 on the oil and gas markets and the future outlook for the industry. First, on the demand side, there's obviously been a significant reduction in mobility as a result of lockdown measures. As can be seen on this map, driven road miles have decreased substantially across the country, down over 50% in many regions. This has translated into reduced demand for gasoline, as seen in the prices at many gas stations. As certain regions start to reopen, however, I could see a scenario where more people end up driving so as to avoid crowded mass transportation. So this gasoline demand could certainly rebound significantly in the coming months, especially if reopening happens at a quicker pace than some people expect. In addition, air travel is down substantially and many flights have been grounded. From flight radar data, we could see that commercial flights are down around 70% from the previous level. With fewer planes in the air, there's definitely been less demand for jet fuel. Depending on the control of the virus, this could be a demand which takes much longer to recover, however. After 9/11, it took around 2 years for the industry to fully recover and reach the previous level of daily flights, so you could be looking at a similar time frame here. And lastly, with the closing down of many businesses, the lights have been turned off and demand for electricity has also substantially declined. This has definitely been partially offset by residential demand for electricity, which has increased with people spending more time at home, but the reduction in commercial demand is certainly very significant. And furthermore, with the bankruptcy of many large retailers and the loss of all the square footage that they need to light, this demand may never fully recover to previous levels. So as mentioned, the reduced demand for these refined products like gasoline and jet fuel has led to the price of crude oil falling off a cliff, down over 50% from last September. Also, as you can see in the first chart, the number of barrels of oil in storage on barges has spiked. Lack of storage is certainly something to watch out for too, especially since this was primarily the cause for the steep decline of the May futures contracts, and these contracts actually went negative because of the lack of storage space at the Cushing facility in Oklahoma. On the supply side, low crude oil prices have also had a significant effect. Below a certain price point, many suppliers actually lose money by continuing to drill, and $30 crude oil certainly doesn't cover costs for many drillers. In fact, petroleum production is down 12% since February, and operators such as Whiting Petroleum have already entered bankruptcy. And also, from a global point of view, Saudi Arabia and Russia have also had to respond to low oil prices, and they did this by agreeing to cut production by 9.7 million barrels, the largest in history, so as to better equate supply and demand in the market and hopefully stabilize prices. In looking to the future, demand for petroleum products will definitely remain suppressed to a degree if some form of lockdown measures are periodically reinstated to combat the virus. If this were to continue, you could likely see further cuts in production as well. But if this doesn't happen and the virus largely remains controlled, the return of demand could see the price of crude oil bounce back rather sharply, given that production cuts have already occurred. And overall, the spread of the virus and the efficacy of lockdown measures will certainly play a significant role in how the next 2 to 3 years really play out for the oil and gas markets.